Hi, welcome to the Plato reporting season wrap-up for February 2025 reporting season. With me, I have the Doctors of Dividend, Dr. Don Hampson and Dr. Pete Gardner. Thank you for joining us.
Thanks, Carl.
No probs. Don, if you could give this reporting season a score out of 10, what would you rank it?
I'm only going to give it 6 out of 10. Reason being, while there were some real highlights like Qantas and A2 Milk paying sort of re-establishing dividends, and the average dividend increase was 20%. Look, the averages can be a bit strange because we had South 32 with an 800% increase in dividends from a tiny to a big amount. So if you look at the median dividend increase, I think it's much better. It was about 5%. So it's not bad. And, that means sort of the typical company was increasing dividends greater than the inflation rate. But if you want to be a downer on things, and I've seen some headlines which, horror dividend season, which I think is, just attention grabbing. The dollar value of dividends was down about 5% as well, 5.6%, because you had the BHPs, the Rios, Fortescues, all those big miners with oil prices down, they've cut their dividends. But, you look back over the last couple of years, they had massive dividends a couple of years ago, and they've pulled back to still pretty good yields on those sort of stocks. So, I think it was okay, but I'm not going to give it any more than that. We can go into some of the highlights, but resources pulled it down, although the good news there was like little gold miners like Evolution, 250% increase. People talk about insurers, some good results from those. But there was some big deviations in prices. So, Bendigo Bank came out with a bit of a soft result. Obviously, banks have been roaring up, and it was off like 17 or 18% on the day on a bit of a actually increased market share, which you say is great, but it did so without making increased profits. So its share price got smacked around on that.
Okay, so a pass mark, but nothing too exceptional.
Yeah.
Don, it was the banks are pretty topical. You mentioned Bendigo then, but I want to bring you back to a piece that you wrote in December where you said CBA was overvalued. We've just had the half-year result come through. Is that still the case?
Well, it is, because it was actually a pretty good result by CBA, but when I say pretty good, their earnings are up 2%, their divvies are up 4.7, I think, call it 5%, which is, it's okay, but their share price is up about 40%. So their PE is 26.5, even though they've come back $10 or so in the last couple of weeks after the Bendigo result. Still look pretty expensive to me. And the yield is now today, I think, 4.1%. Right. Gross, including franking. Their cash yield is actually less than 3%.
Wow.
And that's less than the market. So you think of banks, you normally think, high yielding banks, you're going to get a lot more income in the market. Well, actually not. You get less income out of CBA than if you just bought the ASX 200.
Okay. Peter, let's move to the consumer. What were you seeing in the consumer stocks?
Yeah, so it was an interesting reporting season for consumer stocks. There was a bit of weakness in some of the auto sector, but across the board, they generally did okay. And I'll show you this slide that you guys will probably be able to see on your screen from CBA. And what it shows you is on the left-hand side, it has the disposable income in the Australian market. And you can see that as interest rates rose, that fell quite significantly and the disposable income dropped significantly in Australia. But it's now started to stabilise. And what that's meant is that then if you look on the right-hand side, you can see that the spending from consumer on discretionary items is now actually positive amongst all the different age cohorts. If you went back 6 months ago, the younger people were definitely suffering as higher mortgage rates. And so you had their spending going backwards. The spending is now positive. It's still going better for the older age cohorts that own their own home. But overall, it's positive, which is generally good for the Australian market. And you saw that in the results of a company like JB Hi-Fi, which is able to increase sales almost 10%, increase their profits by 8%. And their sales in January are booming again. They were able to increase their dividend by about 8%. And so it was pretty positive for some of the kind of retail stocks. We consider JB Hi-Fi a bit more of a consumer staple these days. I don't know what you're like with spending on your phone, but I think it's one of the items that people are going to not cut back on as things get tough. And so they had a great result.
It's funny you say that. I just bought a new iPhone and it cost me an absolute fortune. Okay, let's stick with things that you've liked in the past. Pete, insurance is something that you've liked over the last couple of years. Do you still like the insurers?
Yeah, the insurers had really good results. I've chosen a couple here, Suncorp and QBE. Suncorp's profits were 10% above expectations, up 73% on the year. They would increase their dividends by just over 20% for their normal dividend, and then they also paid a special dividend of 22 cents through selling their bank to ANZ. And so they were able to pay a special dividend and also capital return from that. Now, if you look at the insurers and why they're doing well, part of it's because they've been able to increase their premiums by significantly over the last couple of years. They are also having higher investment earnings in the current kind of higher interest rate environment. And then thirdly, it's been a really benign claims environment. And we hope that stays the same for the people in Queensland in particular and northern New South Wales. But yeah, it was a good period for them. It was also a good period for QBE. They've simplified their business quite a bit and are spending, have kind of reduced the risk in their portfolio as well. And so they've been able to increase their profits 27% on last year and 31% increase their dividend. It's only 20% franked because a lot of their profits are earned overseas. But overall, really good result from both Suncorp and QBE.
Okay, excellent. Don, something that hasn't been as strong this reporting season has been the miners. Feels like they've taken a leaf out of Cole's book and things are going down. But this is after years of really strong dividend growth that Plato's taken advantage of. How are you thinking about the miners at the moment?
Well, they're still paying some pretty good dividends. You look at the yield on BHP through to Rio, it's looking 6, 7, 10%. So actually, they're still high-yielding stocks. They have cut their dividends, though, quite substantially. But that's really just in line with iron ore prices coming down. And obviously, the biggest cut is from Fortescue because it's a pure-play iron ore miner. The bright lights, probably more for Rio and BHP, they've been able to increase copper production, and copper prices have still stayed strong. So if you look across minerals, gold's been the standout. Copper is also very strong. Iron ore has been weak. Lithium and nickel are, disaster. Don't want to go there. But that's our process is you go where the dividends are, and there's still some good ones from the gold miners, and there's still pretty good, solid dividends from these. But as you said, they were at record levels a couple of years ago. They've come back down, but they're still paying some pretty good dividends. They've still got pretty good margins, and we still like them from that perspective. And I think probably iron ore prices should stabilise around where they are now.
Okay, that's great context. Pete, any other dividend cuts worth mentioning that you noted throughout the February reporting season?
Yeah, so Don mentioned the iron ore miners. The other area that cut their dividends was the energy stocks, as you saw the drop in the oil and gas prices and also the drop in refining margins. And so that particularly affected both Ampol and Viva Energy. So I've highlighted on this slide Viva Energy, which cut its dividend by 45%, Santos, which cut its dividend by 39%. And the third one, which you might be a bit surprised by, but it's actually Woolworths cutting their dividend 17%.
Oh, wow.
And that was because last year Woolworths had big troubles with their distribution centres. They actually had a few strikes in their critical kind of Christmas trading period, so they struggled to stock their shelves, which meant Coles again won the supermarket wars. They've been winning for the last year or so, and they continued winning in this reporting season. So Coles was up strongly after its result. Woolworths was down, unfortunately, and cut their dividend 17%. So it's a big area of our process is to try and avoid the dividend cuts, and in those three cases, we're underweight more of those stocks.
Fantastic. Okay, well, that's a great summary. Don, I'd love for you to provide an outlook for dividends going into 2025. What's your outlook, Dr. Don?
Well, I think we've seen the worst of the dividend cuts at the market level. In fact, we use the same process we used to try and avoid the Viva Energies, et cetera, of the world. We've developed this model that, so it's not my view, but it's actually a statistical model that tries to forecast the likelihood that companies will cut their next dividend. So look, it's only going out about 6 months, so it's not a longer term view, but you think about, and that's indicating that things are about normal now, back to normal. They had been a bit above, on this slide, high is bad, low is good. It's actually now back to about average, so it's an average outlook, so I don't want to be too bullish. But you think about what's happening in the economy, and actually you saw that in the CBA thing that Pete talked about before. People are starting to spend a bit more, even the young people, which is good for retailers and the general economy. We've seen the first interest rate cut last month, so that will start to flow through. That will increase disposable income for people on mortgages, paying mortgages. There's never one cut. It's more, usually a cycle, interest rate cycle. So I think we'll see a series of cuts and things will get better, I think, as we go into the second half of the year.
Well, thank you to the doctors of dividends, Dr. Don, Dr. Pete. Geez, you've definitely been delivering for clients. The Plato Australian Shares Income Funds has outperformed the ASX 200 on a total return basis, but importantly, you've delivered a 9.5% yield for investors each year per annum since inception in 2011. So congratulations. Obviously, we're talking to advisors constantly who are building retirement income portfolios, and this plays a perfect role for a retirement income portfolio, delivering strong income and also capital growth. The fund's also available as an ASX listed vehicle under the ticker PL8. So that's for the Plato Income Maximizer listed investment company. That ASX ticker, again, is PL8. If you'd like more information, please visit the website, plato.com.au, or you can email through your distribution person here at Pinnacle. Thanks for joining us.